Hello, patrons, YouTube. How are you? Today is going to be an interesting topic because today we're going to be talking about should you be buying now? Of course, the Federal Reserve today is May 5th, 2022. The Federal Reserve once again increased interest rates today, and they expect it to be seven more hikes at least through 2023. And so, one of the biggest question I get asked today is, "Hey, David, should we be buying? Is this a good time to buy?" And obviously, personally, of course, as you know, I am personally bullish on real estate in the U.S., specifically real estate in what I've defined as up and coming rental cities down here in the South. But in this video, I will attempt to actually give an unbiased view or opinion of whether you should buy or whether you should. And yeah, we're just going to dive right into it, and hopefully you find this helpful. All right. With that said, I'm going to go ahead and proceed to share my screen. And so first things first, I'm going to lay the groundwork. We're going to couple information. Okay, so this is all useful. So the interest rates the current interest rate right now today we're going to focus on the 30-year fixed rate mortgage, which is right about 5.2%. Okay, it's important to first understand that, and also understand that the second thing to also remember is the projected interest rate that a lot of experts are predicting, because we're still expecting, like I said, at least 7 or 8 more hikes from the Federal Reserve. Is about the general consensus is probably going to cross 8% by 2025. Exactly when, people are not sure, but it's definitely most likely also going to be around the range of 7 to 7.5%, probably in 2023 2024 timeframe. It's important to remember that. And so also it's important to remember too, another thing that I wanted to make sure I pointed out. Give me a second. Actually, it's not there. It's also important to remember that, when we're looking historically, perfect. Oh, no, this is not it. When we're looking historically, yes, this is it. So when we're looking historically about the decline, so everyone references the 2008 recession, which historically has been one of the worst declines we've seen in real estate in the past damn near 60 years. And so it's always used as a reference point of what you can assume is the worst case when it comes to price correction for real estate. And people tend to overestimate, but I also want to just point out that on average, the decline in 2008 was right about 15%. So keep that in mind. So 15 to 20% worst case scenario was the decline that we saw in 2008, which was the moment right year. And so keep that in mind as well as we go into the topic. Okay, so that said, let's take a pause here. Let's start with the first set of people. So this is typically, and which is essentially the majority of the set of people, which is your first-time home buyers. Okay, so if you're a first-time home buyer and you're debating buying now, here's something you need to understand. You need to ask yourself this question: are you buying for long-term purposes, or are you buying for short-term purposes? The answer typically is people are looking to buy long-term. And also the second thing you also want to consider, we've talked about this in our previous video, is whether the state you're living in has a statewide rent control or it doesn't. If you don't understand that, make sure you check out our previous video on rental cities or strategically investing in real estate focused on rental cities. We talked about the different states, the 25 states which have no statewide rent control, and also the states which do. And more importantly, if you're living in a state with no statewide rent control, this includes like Texas or Georgia, it's important to understand that, like, when a state has no statewide rent control, just to recap, as we discussed in the previous video, that essentially means that apartments and landlords and essentially real estate owners have the right to essentially hike their rents, pretty much whatever percentage they deem fit. And in those cities are the cities where rents are appreciating at a pretty high pace now, because there's an influx of, especially living like in Atlanta, Austin, Dallas, there's an influx of high net worth individuals which are raising the demand for housing, and in essence increasing the cost of living in regards to rent. So keep that in mind, that if you're renting in such a city, so like Charlotte, North Carolina, example, Raleigh, North Carolina, Atlanta, Georgia, Nashville, Tennessee, Dallas, Texas, Houston, Texas, Austin, Texas, all this city, Tallahassee, Florida, Jacksonville, Florida, all these cities are seeing increasing hikes in rent because there's no statewide rent control. And of course, since these are what they call migration cities, where high net worth individuals are flocking towards, you're going to experience a lot of hikes in rent. And so if you're living in those cities, just understand that a huge risk continuing to rent is that you have no control about what the market demand would be in regards to the rental prices. And essentially, if you choose to rent, you're going to have to stick or accept whatever the market deems is, the price for, let's say, your two-bedroom apartment, one-bedroom studio, and so on and so forth. And so when you own a mortgage, one advantage of owning a mortgage is that you fix your principal and interest. So that payment stays fixed throughout the term of the mortgage, unless you refinance, of course. And then naturally, the part that is changing is like your HOA and escrow. Escrow meaning your property taxes or home insurance. And those are a small portion of your overall mortgage payment. So for the most part, one major advantage to keep in mind if you're buying as a first-time home buyer or buying a primary residence is that owning a mortgage you have more control over how much you're paying for your mortgage versus how much you'd be paying in rent, where you have no control over that. And now let's dive into the math. I like to, aside from just looking at things from just a conversational perspective, also like to look at things in math. So let's go back to our handy dandy, what we like to use, mortgagecalculator.org. Now keep this in mind. So we're going to use an example. Let's assume this is a $400,000 home. Most first-time home buyers are probably doing like a 5% down, and current interest rates right now, like we showed earlier, was 5.2%. Okay, this is a 30-year loan, right? Starting property taxes again is about 1%, PMI 0.5%, home insurance $1,000 a year, HOA, let's assume HOA, conventional loan, buying. Okay, remember this figure. This person or this first-time home buyer will be paying about $2,600 a month, or $2,645 to be exact, in mortgage, just to include your escrow, PMI, everything. Now, I always like to look at it in a model. So this is the case one, if this first-time home buyer were to buy now. Now, I know a lot of people are saying, well, I want to wait because I rather wait for the prices to dip and so on and so forth. Now, keep this in mind. The whole idea of the housing crash bubble, or the whole conversation that's come up recently, really stemmed from this article from the Federal Reserve Bank of Dallas back in March of 2022. And, they brought up some solid points. I mean, I can link this in the description below, but what's important is, of all the points they brought up, a lot of people were screaming and calling for a 2008 type bubble crash. And I would say, they could have worded this better, but I think they intentionally did this to catch the attention, and it worked. It was definitely effective. This is definitely a usually talked about article, but there's one thing I want to bring to the attention of, it seems like people missed. I appreciate the authors because I feel like this was very unbiased. They brought a solid case for why, if you were entering the market, you should be concerned. But one thing that they highlighted, they said I wanted to highlight is that, based on present evidence, there's no expectation that fallout from a housing correction would be comparable to the 2007 to 2009 global financial crisis in terms of magnitude or macroeconomic gravity. That's a very important statement, although it was said towards the bottom and in the conclusion, but it's a very important statement, and it's also necessary when we go into our modeling, because it's important to understand that basically the Federal Reserve Bank of Dallas is basically saying, which I agree with, that while we might see a correction, and we probably will, the correction will not be of the magnitude of 2008 crisis. And then if you remember, going back to our chart here, we know that the 2008 crisis had a correction of right about 15% change in price. So knowing that, and obviously if you're into numbers, it's very easy to model scenarios, right? And also, the last point, like we said, we're expecting mortgage interest rates to be really anywhere from 7 to 8% by 2025, and their experts are saying around 7 to 7.5%, even as early as 2023. Okay, but even keeping that in mind, so in a case where, let's say, even we see the worst case price correction, again, remember this: if we do see a price correction, we're not expecting the price correction to be as bad as 2008. But for the sake of our model, we're even going to model the worst case price correction. So let's say the price is 400K. Let's even assume we see the full blown. We see the full blown 240,000. So let's say assume we see the full blown price correction of 15%. So that means our purchase price will drop by 15%. So that means our purchase price now will be 340,000. Okay. So if we see 340,000 now, let's say the home drops. This could be 2023, 2024, 2025, whenever the price correction comes. And we remember, we're expecting interest rates to go up to, let's just say 7.5 for the sake of modeling, 7 to 8 range. So we'll just pick right in the middle, 7.5. Okay, so 340, oh, down payment, sorry. The down payment is still 5%, but interest rates now is 7.5. Okay, so down payment is 5% still. The same, first time home buyer doing a 5% down payment, but now the interest, of course, while the home value has dropped, again, we are modeling the worst case scenario based on the 2008 price action. We're still going to keep we're not, but we have to raise the interest rate up to 7.5%. And what we see here is that in the same model, let's even keep the property taxes higher still, even to benefit. The same model, remember, this was our first mortgage right here. If we go ahead and hit calculate, you see that actually, despite the drop in price of the home, okay, because of the interest rate hikes, and again, you can feel free to go and do your due diligence. Again, it's hard to predict these things, but most experts, for the general consensus is that we will see more hikes through to 2023. And more importantly, we will see that the hikes will reach 7 to 8%, the interest rate, by 2025 at least. And so modeling that, you'll see that actually, despite waiting for a drop, you still have a higher mortgage, even with the price drop. Now, the cool thing, so keep that in mind. So sometimes it's easy to approach these things by looking at math. I know some people are always thinking, oh, it's better to wait so my mortgage payment will be lower. But I'm like, wait, even though price does drop, depending on where interest rates are, your mortgage payment could indeed not be lower, because that's just how math works, right? And so also something to keep in mind is, I also always tell people, first-time home buyers, so keeping that in mind, you want to have it's ideal to have a mortgage, because you have more control over that. Like I said, your principal and interest payments, so that's this part. Principal and interest payments is pretty much, which is a portion of your mortgage, is fixed. And the only part that changes within your mortgage is your escrow payments. And so there's more control over your monthly payments with the mortgage versus with the rent, especially if you're in a state that has no statewide rent control. And two, in summary, even with the worst case price correction, which is 15%, you see, because of the interest rate hikes, right, it could also make it not cost advantageous to buy at a later date. So let's see, I think the interest rates will have to stay below 7% to even be comparable. So the interest rates are basically, if you're choosing to buy in the future in this exact scenario we've modeled, right, the interest rates would, you first need to, so if you're choosing to buy in the future, so these are two assumptions that needs to be right for you to have a cheaper interest rate. So in this case, 2618, you need the interest rate to be essentially lower than 6.7%, and that's a huge assumption. And you need the price correction to be as bad as the 2008 price correction, which we showed was 15%, which is how we got the 340,000. And as we just showed you from which I'll call this the originating article that sent people in a frenzy. Where is it? The Federal Reserve. Yes, the sent people in a frenzy. We can see clearly that the Federal Reserve Bank of Dallas states that there's no expectation that the fallout from a housing correction will be comparable to the 2008 price correction. So that's something key to keep in mind. And so, when you factor that in, also keep in mind that even if you buy now with your home at what I'll say at a lower, at the current interest rate, if the interest rate is good to lock in the interest rate low, and such that if the interest rate does eventually drop in the future, which it may be beyond 2025, you can always refinance to a lower interest rate. So typically the general rule of thumb is, if your interest rate drops to 1%, so if the market interest rate drops to 1% below than your current loan term interest rate, so for instance, if you get a mortgage now at 5.2, it's advisable that you wait to whenever the mortgage interest rate drops to like 4.2% or below, and you can always refinance. So that's something that's always available. And I always say, when it boils down to it, when you buy a home as a primary, even though prices does drop, you can, the general rule of thumb is that in every 5 to 10 year period, so 5 to 10 year period is really called long-term investing in real estate. In most 5 to 10 year periods, most properties tend to appreciate. So provided you're investing long-term, that means if you plan to hold your property for at least 5 years or within 5 to 10 years in that time frame, most properties tend to appreciate. So even in general, you only see cases where the property depreciates in value if it's very old or maybe not well maintained or as maybe undergone severe damages. So for the most part, if you're maintaining your property well and you're keeping it up to date, your property should also appreciate in value within 5 to 10 years. So that's another thing to factor. If you're first time investor and you're looking to buy long term, even though there might be price correction in the short term, in the long term, you can assume that your property value will appreciate in general, provided you're doing your part to keep up with the property and maintain. And then, so that's my, for the first time home buyers or people buying as primary residences. Now, with the investors, I always like to say, with us, it's a bit easier because when it boils down to it, with us, what it boils down to is the cash on cash returns, right? We've covered cash on cash returns in the past. We've talked about estimating short term rental deals. And so I can link that as well. You can just go to our YouTube channel and look at our previous videos. We've talked about that. So I won't necessarily go into depth in this video, but as an investor, for me, I mean, interest rates high or not, I think it's good to focus on cash on cash returns. And obviously, naturally, your interest rates will affect your mortgage payments. So of course, higher interest rate means higher mortgage payments. So of course, if you reach the point on a property where you're estimating the deal and the cash on cash returns is not sitting pretty at 18% or higher, you walk away. If it's looking good, it's good to proceed with the deal. And I'll get same thing like we just mentioned for the first-time home buyers as an investor too. Whenever interest rates does cool off again and maybe drop to 1% or lower than your current interest rate on your investment property, you can always refinance your investment property to the lower interest rate. So again, I know it's hard to stay unbiased on these topics because I am bullish on real estate. So I do want to put that as a disclaimer, but I like to take like a very rational approach to these things. So the question is, so basically what it boils down to is if you invest in long term, meaning you plan to hold your property for 5 years or longer, whether you're buying it, again, like I said, for investors, it's simple. You just look at your cash and cash returns. But if you're a first time home buyer, you invest in long term, you're living in a state that does not have any statewide rent control. And it's more especially when you do the analysis, like we just showed you, in some cases, it might be more advantageous to buy now and lock in now. And again, like I said, if interest rates do eventually drop, you can always refinance. And of course, even though there's short-term price action or price correction in general, with real estate, especially when you're looking at tier A real estate typically means like new construction, middle to upper class neighborhoods. Tier A real estate, basically, or tier A or class A, depending on how you reference it, you're typically looking at appreciation in that time frame. And with that, we're signing out. I hope this was useful, something to consider or offer a different perspective when it comes to looking at the market. Remember, stay rational and have a good one.